Hello and welcome to Money in Motion video blog. This is Dan Perkins. Today I want to talk to you about three things. First, I want to revisit our last blog about volatility and how it impacted the statement values in the month of January. Two, I want to talk about Greece and its impact on the markets. And lastly, I want to talk about changes that are being contemplated in Washington, D.C. So we've got a lot to cover today. Let's get started. The first issue is account statements. In my last video blog, I talked about volatility, meaning that prices can vary from month to month based on market conditions. What we saw in the month of January was a significant appreciation in the value of the assets, probably for no other reason other than the fact that the Fed announced about mid-month that they intend to be on hold with short-term interest rates in the range of 0 to 25 basis points, probably until 2014. After the Fed made that announcement, many private sector economists came out and said that they believed that the Fed was probably on hold till about 2015 or 2016. The realization that money market funds were not going to recover, more on that in a little bit, and that they were going to continue to pay zero return, that short-term money market instruments were going to be close to zero or minimal returns in that 0 to 25 basis points range. Many of the things that we own, whether it was royalty trusts or limited partnerships or preferred stocks or mortgage REITs, all did extremely well. In fact, they outperformed the market dramatically in the month of January. Now, that's not to say things can't reverse themselves and we'll see some sell-off in the month of February. But I think what it does say, when the market was looking for something to buy, they wanted to buy what we already owned. The challenge for me is to continue to try and find things to own that will pay us reasonable rates of return. Now, I want to move on to Greece. It's kind of like a never-ending story. One day we're going to settle, the next day we're not. I think there's a possibility with the Greek government having about $100 billion of debt rolling over in March, that we're going to get some kind of a compromise to help the Greece government deal with its deficit. I'm not sure, however, that the Greece people are going to agree with it. I think it's going to be very difficult to get the Greece people to agree to, regardless of what the politicians say, the austerity measures that the IMF and the European Central Bank want in place in order to provide the loan guarantees and the money to Greece to keep it solvent. So it's a sleeping giant that nobody seems to be paying attention to at the moment. While it's in the headlines, it's not being factored into what's happening in the markets. The euro seems to be rallying nicely on the potential that Greece will solve its problems. But as soon as we solve Greece's problems, we've got to deal with Portugal, Spain, and Italy. And so the whole southern tier of the European Central Union is under economic and financial pressure. This is not going to go away anytime soon. And it will begin to weigh, in my opinion, on the totality of the world markets and the world economies. As austerity becomes more and more the benchmark of what has to be done in Europe to try and save the European Union, they're going to be spending less, and economies like Japan and other BRIC countries, Brazil, India, China, and Russia, are going to find their economies probably beginning to slip. I'm not ruling out the possibility that we have a major default and declared default in Greece sometime in March, which could wreak havoc with the capital markets and the credit markets on a global basis. I would see, however, if that were to happen, a significant rush to U.S. Treasuries, which would drive yields down. And because people are concerned about the flight to quality, they will want to own U.S. government securities because it's the safest treasury in the world. It's also the largest and most liquid market in the world. So I expect there's the possibility there'd be a big run on the bank to buy treasuries, which could see significant decline in interest rates maybe by the end of the first quarter of this year. I think that, speaking of returns, you're about to see a chart of the S&P 500 for the month of January. And the old axiom is, so goes January, so goes the market. And you can see that there are 4 clearly defined weeks in the month of January, each week supposedly representing each quarter. And you can see that the first half of the year looks very attractive. The third quarter looks relatively flat. And then the last quarter shows a spike down, probably in October or November. So the sense is that the first half of the year will be more interesting than the second half of the year. I don't think I disagree with that. Whether or not the market will tend to be up for the year, there's a second indicator called the Super Bowl indicator, and that is, if I'm correct, when an original NFL team like our New York Giants wins the Super Bowl, the market is generally up for the year. So the Giants won, so that predictor should say that we should see an increase in the market this year. I think it's going to be tough. I expect to see continued volatility. We could see some very significant spikes in volatility if we have a problem with Greece or Portugal or Spain or Italy or all of them sometime during the year. So it's not going to be an easy year. Don't get overly comfortable with the great returns that you had in the month of January. The last topic is what's going on in Washington, and there's a significantly heated battle going on between the money market mutual fund industry and the chairman of the Securities and Exchange Commission over what should be done with money market mutual funds. I have to say I'm a participant in that argument, in that I have submitted several papers, white papers included, to the Securities and Exchange Commission over the last couple of years, expressing my views and opinions, and I have gotten some feedback recently to those opinions. The 2 issues that are on the table at the moment being considered by the commissioners of the SEC is to whether or not to put out for public comment 2 more revisions in how money market funds would function. The first provision has been talked about since 2008, and that is breaking the buck, letting the $1 net asset value of the fund fluctuate based on the market value. The SEC's contention is that the only reason that the dollar is maintained is because the management companies have been funding the expenses of the funds to try and keep the net asset value at $1. They are under no contractual obligation to do such, and the SEC is concerned that if they decide no longer to support the fund, there could be a significant problem. Now, when the reserve fund lost $785 million in one transaction in 2008, it caused a run on money market mutual funds, and as a result, the Federal Reserve had to step in with $180 billion of backup to provide liquidity for money market mutual funds. I don't think that having a floating net asset value on a money market fund makes much difference, because I know I'm not going to make a return. So why should I want to be concerned about the yield on money market funds if it's not making anything? The fact that it may drop in value to 99 cents or increase to 101, it's not making me any significant return. And the Fed's already told us we're not going to make any money. So I would buy it for a totally different reason. The SEC estimates that the fund industry has already spent $40 billion propping up the NAV. And if the federal chairman is correct of the Federal Reserve that he's going to keep rates low for another 3 to 4 to maybe 5 years, one could see another $60 to $75 million, or over $1 billion, over $100 billion of losses in the money market fund industry in order to keep the NAV at $1. I think its time is past. I think it is significant, however, that money market fund assets have dwindled. We're down to a mere $2.6 billion, down from over $4.2 billion. And now only 625 funds still in the marketplace. I know those sound like huge numbers, but you must understand that of the 625 companies that offer money market mutual funds, whether they be Treasury, general, or tax-free, 75% of assets are controlled by about 10 funds, and about 25 funds control over 95% of the assets in these funds. If I had a concern about money market funds, I would be very concerned about the high concentration in a small number of funds with hundreds of billions of dollars of assets. And if there's a problem with them all buying the same stuff, if there's a problem with one piece of investment, it could have a significant impact on what is a very small percentage of the industry, but a very high percentage of the assets. The second part is the SEC does not believe that taxpayers' money should be used to backstop money market mutual funds like was done in 2009, where the Fed put in $180 billion to provide liquidity. So they want to propose a new provision that says if you want to take all of your money out of a money market fund, you can take 95% of it out initially. The other 5% will be retained for a liquidity opportunity to help support redemptions for the fund, and then you'll get your money back 30 days later. Now, in speaking to one client about that, she said, well, I'm not going to earn anything on the money if the fund holds it for 30 days. And I reminded her she's not earning anything anyhow now, so no big deal to not earning money for the next 30 days. This is a provision that has the support of the chairman of the SEC, and her position is we have to make sure that there's liquidity to meet redemptions if there's a run on the bank within the industry itself, not dependent upon taxpayers' dollars to provide the liquidity. Now, as I understand it, 3 of the 5 commissioners of the SEC have to approve this for public comment. There'll be a public comment period, probably 60 to 90 days, and then the commission will render its findings. It's interesting that even though they haven't voted on these 2 provisions, Federated Investors, the 3rd largest money market mutual fund management company in the country, its chairman has already indicated that if either of these provisions are approved by the SEC, it fully intends to sue. I think that's a little short-sighted because I think that those people who are going to take their money out that the industry is afraid of, as soon as the comment period goes out and the SEC decides they're going to issue these new provisions, whether they're challenged in the court or not, those people who are nervous are going to take their money out regardless. The practical reality is, as I said to the Securities and Exchange Commission, practically there's no real other place to go. And most of my clients see the money market fund as a vehicle to hold money while we're trying to figure out where to put it for a better return. So a lot of controversy, you're going to see a lot of press. And so watch the Wall Street Journal and USA Today and the other financial publications about this happening relatively soon. So that's a full blog today. Thank you for watching. If you have questions or comments, please feel free to give me a call. If you have friends or relatives that are looking for somebody to help them manage their money, please feel free to give my name and number, and I'd be happy to talk to them and see if we can do business together. Thanks for watching, and look for the next blog soon.